Imagine holding a $100 bill in your hand. You think it's worth $100, but the truth is that value has been quietly eroded for decades by design. Every transaction, every price tag, every paycheck, it's all part of a system that subtly chips away at your purchasing power. Most people never notice, and that's exactly how it's meant to be. Currencies were supposed to be tools, mediums of exchange, but today they are instruments of control. They are rigged, not in some conspiracy theory sense, but in the hard, observable mechanics of global finance. Governments, central banks, commercial banks, and large institutional investors all play a role. The rules appear neutral, but they favor certain actors, often leaving the average person one step behind. The question isn't just theoretical. Your savings, your investments, even your daily spending are affected. And right now, with inflation cycles, digital currencies emerging, and economic shocks happening more frequently, this hidden rigging has real, immediate consequences. Let's start with the basics. A currency, at first glance, is just paper, metal, or digital ledger entries. Its value is meant to represent the goods and services you can buy. But behind the scenes, the story is far messier. Central banks set interest rates. They control the supply of money. That seems simple. But money isn't just created randomly. It's created strategically, often in ways that favor governments and large financial institutions. For example, when a central bank prints money to stimulate the economy, the early recipients, banks, corporations, investors, benefit first. Everyday consumers see the effects later, usually in higher prices. There's also the invisible web of currency exchange rates. Every time you convert dollars to euros or yen to pounds, there's a hidden cost, not just fees, but systemic biases in how rates are calculated, how large trades influence the market, and how central banks intervene quietly to stabilize or destabilize economies in ways that benefit specific interests. Here's the uncomfortable part. Let's do some numbers. Suppose inflation runs at 3% per year. That means $100 today buys about $97 worth of goods in a year. That seems small, but over 10 years, that $100 buys only about $74 worth of goods. Over 20 years, about $55. Now layer in bank fees, exchange spreads, hidden taxes, and government interventions. Your purchasing power erodes faster than most people realize. Yet the media often reports stable currencies, and politicians talk about economic growth. The reality, the system silently penalizes ordinary holders of money, rewarding those who manage or move large sums first. Why does this happen? Incentives. Central banks want stability, but they also want influence. Banks want profit. Investors want leverage. Governments want control. Everyday people holding cash? Not really a priority. The system is engineered to concentrate advantages at the top, often disguised as necessary economic measures. Take interest rates again. When rates are low, debt becomes cheap. Governments borrow more. Large institutions can borrow cheaply and invest in higher-yielding assets. You, with your savings account, get almost nothing in return. That's how the rigging works. It's subtle, structural, and mathematically baked in. Most people believe currencies are neutral. They think inflation, exchange rates, and economic policies are random or fair. That's the public story, repeated endlessly in media and school economics. The reality, markets are influenced daily by hidden mechanics, hedge funds moving billions, central banks swapping currencies quietly, governments manipulating rates for political leverage. All of this occurs outside of public attention, leaving ordinary holders of money at a disadvantage. The irony is stark. People trust money, but money doesn't trust them back. Look globally. Some currencies are pegged, some float freely. Some countries experience hyperinflation, others maintain strict monetary controls. But in every system, the mechanisms favor early movers, insiders, and institutions.
Even digital currencies, often promoted as democratizing finance, are subject to similar dynamics. Early adopters, whales, and large exchanges reap disproportionate advantages. The lesson is universal. If you're holding money, you're playing a game with rules stacked subtly against you. So what does this mean for you? Awareness is the first step. Understanding that currencies are not neutral, that your purchasing power is subtly eroded, that incentives favor the top tiers of the financial hierarchy. These are uncomfortable truths. But here's the unresolved question to leave your mind turning. If currencies are inherently rigged, is there ever a truly neutral way to store and transfer value? Or is the system itself, by design, always tilted, and the only variable left for you to control is how you play within it? And as you ponder that, remember, every decision you make with money, saving, investing, spending, is made inside a framework that already has its own biases. The question isn't whether the system is rigged, it is, what will you do knowing that it is?